Aditya Khemka joins us now, Fund Manager of InCred Healthcare PMS. Let's connect with him to understand that what are the trends in the pharma space and how things looking up. So Aditya, can you just broadly tell us that what are the price trends in pharma? Stock price, not stock price trends, but the industry trends in terms of whether generic, formulation, API, where are the cycles moving?
Yeah, hi. Thanks for having me. Good morning. So in terms of the generics, the US generics, as we call it, the unbranded generics, the pricing is still going down. You have to divide basically the US generic business into two parts. The oral solids and everything excluding the oral solids, particularly injectables. So I think in oral solids, the pricing pressure is still quite severe. Most of the pharma companies in the fourth quarter results commented that the pricing for oral solids is still declining high single digit to low double digits. On the injectable side, the pricing remains interesting. Most of the injectable products continue to be in shortage in the US market, and hence we see single digit or low single digit price inflation in those products other than price erosion. So therefore, we feel that injectables is probably a place where there is still more competition to come, and pricing will eventually normalize in the injectable space in the US generic market. So these were the formulation drug pricing. In terms of the API pricing, I think API pricing continues to be soft. But what is happening with the API companies is that they had faced tremendous input cost pressure from China over the last 2 years. So that pressure is now subsiding. And because the pressures in the input cost are subsiding, we have margin accretion happening across API companies. So Chinese chemical factories are basically back online, back in full swing, but the Chinese consumption isn't really back full swing. So the Chinese API production is Chinese chemical production is basically being dumped across various markets, and the pricing is very, very low, and that will benefit the API players in India. Coming to diagnostics and healthcare, which is hospitals, I think diagnostics, we have seen price inflation across. So companies like Dr. Lal, Thyrocare, all have commented that they have increased prices in certain pockets of their business. Obviously not across all tests, but in certain tests they have increased prices. And in healthcare, which is hospitals, we see price increases, RPOB increases happening across hospitals. It is obviously a function of case mix as well, but we feel that the service prices have also gone up. So barring maybe unbranded generics, across branded generics, API, hospitals and diagnostics, we see pricing and margin trends improving.
What is happening to India and what is happening globally?
So in India, the pricing is actually a function of the regulation, right? So regulation states that in India, the drugs which are under NLEM can take price, NLEM, which is essentially price control. So drugs which are under price control can take price increases up to the WPI for the last year. So this year, that percentage number comes to 12.2%. So, all pharma companies are free to take price increases of 12.2% on their price control drugs this year. And for the non-NLEM portfolio, they can any year take up to 10%. So last year, if you see, the data suggests that Indian companies took 6 to 7% price increase on a weighted average basis. This year, we expect a similar price increase, 6 to 7%. What is very interesting here, Nikunj, is that this year, while input costs are going down in terms of chemical prices coming off and hence API prices remaining soft, the input prices for these branded generic companies will remain soft. However, they are still increasing prices. So their margin will see that double impact. The cost will come down and the price will go up. And we expect the branded generic prices to, branded generic margins to improve significantly this year.
Aditya, hi, morning. What I find intriguing is, how you're talking about one should be looking at pharma and you're comparing hospitals to branded apparel retail. What's the rationale here?
So look, it's a very interesting question and it's a very interesting business model, just like branded apparel retail, right? So let's take an example of a Trent, right? So if Trent were to open a showroom or a EBO, as they call it, anywhere, let's say in Bandra, so the population that they're basically targeting is population which lives, let's say, 4 to 8 kilometers radius of that store. Hospitals are pretty much the same business. When they open these hospitals, they actually target the vicinity of 4 to 10 kilometer radius from the location of the hospital. And that is why it is sort of a correlated business to apparel retail, sort of a similar business model. We look at stuff like RPOB in hospitals, but we look at SSG in retail stores, essentially the same metrics. We also ask hospitals what is the growth of their mature centers, which is again SSG. And the only thing is that in retail stores, the customer may not have much loyalty, But in hospitals, customers have very high loyalty. So when you walk into a retail store, you decide whether you buy one shirt, two shirt, a trouser as well, a tie as well or not. When you walk into a hospital, you just don't get to decide what you buy and what you don't buy. You're told what to buy and what not to buy, and you have to buy. So that's one distinction. The second distinction is in the retail stores, you have a lot of inventory, and inventory is the biggest challenge to manage for these guys. So working capital is generally high. In hospitals, the working capital is actually negative. So we compare the operating model to hospitals and retail stores, but the economics of our hospitals are far superior to retail stores.
Hospitals have a very different way in where things move. You know, there is insurance angle, there is a profit sharing angle with the doctors. The capex is insanely high. So can we really compare them? And there is no e-commerce, by the way.
Yeah, that's true. So let's see, hospitals have insurance angle, that's true, and retail stores don't have that. But there are other compensating factors, right? As I said, hospitals don't carry inventory, they don't carry working capital, retail stores carry working capital. If, for example, let's say in retail, so you said hospitals, for instance, do not have, or hospitals, for instance, have a profit sharing, right, with the doctors. In some sense, they have to pay the doctors. The retail stores have to pay the designers, right? So it's not that different if you think about it. In fact, if you look at the economics, as I would put it again, so the way we compare it is on the strategic side, that if I am a business owner of a hospital chain, and if I were to open a new hospital, what are the variables that I look at, and how would I evaluate if my hospital is doing well or not? Those metrics that I look at when I open a new hospital and how I evaluate my hospital are very much similar to the metrics a retail store looks at when they open a new store and when they evaluate whether the new store is doing well or not. So that is the perspective from which we are coming, that they are comparable. But as I said, economic standpoint, actually hospitals are superior to retail stores. If you look at working capital, if you look at mature store ROEs, if you look at the captive audience, the loyalty of the patient and the brand, and the loyalty of the patient to the brand, you will see that hospitals are actually more. So this is all data in terms of growth and in terms of ROEs that these hospitals do versus what retail stores do. So data tells us that hospitals economically are superior, but the strategic way of looking at these businesses, operating models, are actually similar.
Right. Okay, Aditya, interesting. Thanks for joining in with your observations there.
Thank you.